Many of you have felt the quiet hum of market uncertainty, the whisper of doubt even when following the most popular advice. You've been told that passive investing is the answer, the serene harbor in a stormy financial sea. And for many, it seems to offer a comfortable simplicity, a path of least resistance to wealth. Yet, a part of you, that deep, analytical core, still wonders, does simplicity truly equate to mastery? Is there more beneath the calm surface than the mainstream narrative suggests? Perhaps you've found yourself adrift in the vast ocean of conflicting financial information, grasping at what seems simple, what promises ease. The allure of passive investing, with its promise of broad diversification and minimal effort, can feel like a gentle hand guiding you through the storm. But that fear of making costly investment mistakes, that frustration with opaque advice, still lingers. You crave a deeper understanding, a connection with data-driven truth that goes beyond superficial headlines. Benjamin Graham, the profound architect of intelligent investing, offered a timeless compass when he stated, "Investment is most intelligent when it is most businesslike." To be truly businesslike in your approach to wealth means more than just participating. It means understanding the hidden levers, the underlying mechanisms, the very engine of the market, even when you choose a seemingly passive path. It means asking, what are the true costs, the subtle risks, the unspoken assumptions within this passive journey? The widespread embrace of passive investing is often presented as a no-brainer solution for wealth accumulation. But the critical investor, the one who truly seeks financial mastery, knows that even in simplicity, there are layers of complexity waiting to be peeled back. We are here to uncover the hidden truths behind wealth accumulation, to not just invest, but to understand the why behind every decision. Don't just invest, understand the why behind every decision. Today, we begin a journey to demystify the widespread embrace of passive investing. We will challenge the consensus and find your true edge, revealing 7 hidden truths that will empower your most informed, data-driven investment decisions. Beyond the headlines, what's really driving the market? Are you ready to look beyond the veil? Many of us, in our earnest pursuit of financial peace, have embraced the mantra of set it and forget it, a soothing balm for the silent fear of investment inadequacy. We yearn to truly understand, to confidently navigate the market's nuances, yet the promise of hands-off passive strategies often masks this deeper desire. Is your diversified portfolio truly diversified? But does passive truly mean abandoning the helm? This belief often distorts reality, suggesting that passive investing eliminates all active decision-making. To simply accept a broad market index without scrutinizing its very architecture, its construction, its rebalancing rules, its ongoing relevances, to fall prey to a subtle form of confirmation bias. We are uncovering the hidden truths behind wealth accumulation. The expectation of zero effort shatters when we consider the constant, albeit subtle, demands. Annual rebalancing, the strategic dance of bringing your portfolio back into alignment, is an active decision. Tax loss harvesting, a nuanced maneuver to optimize your gains, is a choice. Understanding how an index methodology shifts, how it adapts or fails to adapt to market cycles, requires your continuous attention, your strategic thought. Don't just invest, understand the why behind every decision. To discern genuine market exposure versus algorithmic drift, consider a 3-step strategic finance technique. First, deconstruct your index's sector and geographic weighting. Do you truly understand what you own? Second, analyze its rebalancing frequency and rules, comparing them against the natural rhythms of market cycles. Third, stress test its historical performance during periods of significant market rotation. Even the venerable John Bogle, often revered as the pioneer of index investing, did not stumble into his creation passively. His was a deliberate, strategic choice, born from deep conviction and an intimate understanding of market mechanics. It was not blind faith in automation, but a profound, active analysis of how best to serve the long-term investor. So, as you walk this path, ask yourself, is your passive strategy truly a serene autopilot? Or is it a sophisticated vessel that still demands your vigilant, active mind at the compass? What hidden choices are you making, even when you believe you are making none? That quiet unease you feel about financial authority, the lingering doubt about whether you are truly seeing all the costs, is a valid intuition. You desire to uncover every single expense that erodes your long-term wealth, to move beyond the advertised expense ratios and grasp the total cost of ownership. This deep-seated need to see clearly is a powerful, protective instinct. We are often led to believe that passive funds are inherently low cost, a beacon of efficiency in a sea of complexity. Yet, this common distortion often overlooks the subtle, hidden transaction costs that build up within the fund itself. It ignores the bid-ask spreads incurred during trading, and it can gloss over potential tax inefficiencies, like capital gains distributions, that subtly compound their erosion of your returns over time. These are not just numbers, they are quiet whispers of diminishment. Consider a counterintuitive truth. Seemingly small, unadvertised costs can subtly sabotage your compound compounding magic. Take tracking error, for instance, the quiet divergence between your fund's performance and the index it aims to mimic, or the way a fund retains revenue from securities lending. These are not explicit fees, but inherent frictions that, like tiny grains of sand, can slow the turning gears of your wealth. Focusing only on explicit fees can be a form of loss aversion, blinding us to these deeper currents. To truly master your financial landscape, we offer a practical, data-driven method for forensic fee analysis. First, calculate your fund's true tracking error over multiple periods. How closely does it truly hug its benchmark? Second, analyze its internal trading volume against the underlying index's liquidity. Is it moving with grace or with friction? Third, scrutinize its tax efficiency by comparing turnover rates and capital gains distributions. These steps reveal the genuine market exposure beyond the headlines. The realization that you might have been paying more than you thought can stir a mild stress, a tightening in the chest. This is not a burden, but a spark. It activates a deeper drive to dissect and truly master your investment costs, to enhance your financial literacy and stand firm in your informed decisions. Is your low-cost fund truly as low-cost as you once believed? Challenge the consensus. Find your edge. That quiet fear, the one that whispers of investment inadequacy, often surfaces when we realize our diversified passive portfolio might actually be heavily concentrated in a handful of mega-cap stocks. You yearn for truly independent, informed decisions about your portfolio structure, a desire to move beyond the comforting illusion of effortless diversification. This yearning is a compass guiding you towards deeper truth. The myth that market cap weighting inherently provides optimal diversification is a pervasive one. It often hides a subtle anchoring bias, drawing us towards the largest companies, almost regardless of their fundamental value, their future growth prospects, or the systemic risks they might carry. We are conditioned to believe that bigger is safer, but is it always wiser? Beyond the headlines, what's really driving the market? This expectation of effortless, broad diversification is often shattered by a counterintuitive truth. Market cap weighted indices inherently buy more of what's already expensive and less of what's cheap. This creates a systemic momentum trap, a quiet vulnerability that can lead to significant drawdowns when the market leadership shifts or when reversals inevitably occur. It's like sailing into a strong current, believing it will always carry you forward. To truly discern your portfolio's diversification within an index, consider a three-step quantitative technique. First, calculate your index's Herfindahl-Hirschman index, or HHI, for concentration. This will reveal the true distribution of power within your holdings. Second, analyze your sector and geographic weighting, aligning it with your personal risk tolerance and macro outlook. Does it truly reflect your worldview? Third, compare your index's top holdings concentration to truly equal-weighted or fundamentally weighted alternatives. We are uncovering the hidden truths behind wealth accumulation. The story of the dot-com bubble serves as a stark, visceral reminder. Market cap-weighted indices then amplified the speculative frenzy, pushing valuations to unsustainable heights. Those who blindly followed found themselves caught in the devastating crash, a powerful testament to the critical importance of independent thought over market sentiment. Is your diversified portfolio truly diversified? Don't just invest, understand the why behind every decision. Have you ever felt a philosophical wound, a quiet unease when questioning the fundamental fairness or logic of market mechanisms, especially when told that passive investing is inherently superior? There's a deep desire within you to understand the symbiotic, often hidden, relationship between active and passive investing. To truly grasp how this intricate dance truly works, this quest for clarity is a sacred one. The common distortion suggests that passive investing is a self-sustaining system, a perpetual motion machine of wealth. Yet, this view ignores the foundational, irreplaceable role of active managers in setting accurate prices and efficiently allocating capital across the market. This critical truth is often obscured by an overconfidence bias in passive superiority, a belief that the market simply is without acknowledging the hands that shape it. We are uncovering the hidden truths behind wealth accumulation. Here is a counterintuitive truth. If every single investor went passive, if no one actively researched, analyzed, or challenged valuations, price discovery would utterly fail. The market would become inefficient, a ship without a rudder, rendering passive strategies ineffective because there would be no underlying intelligence to track. This reveals the free rider problem at the very heart of passive investing, where active managers do the heavy lifting of analysis and risk-taking, allowing passive funds to simply follow. To truly understand this market equilibrium, consider a strategic finance framework. Analyze the proportion of active versus passive assets in various market segments. Study the profound impact of large institutional active funds on price signals, recognizing how their research and arbitrage activities drive innovation and guide capital to its most productive uses. Don't just invest, understand understand the why behind every decision. Passive investing is like a passenger on a meticulously designed train, enjoying the journey on tracks already laid. But active investors are the engineers, tirelessly laying those tracks, maintaining the powerful engine, and steering its direction through the ever-changing landscape. Without these engineers, this vital, active force, the train goes nowhere, no matter how many passengers are on board. Is your diversified portfolio truly diversified? Challenge the consensus. Find your edge. That overwhelm you feel from the sheer volume of financial information, often leading to analysis paralysis, is a heavy burden. And when market downturns expose the raw emotional vulnerability beneath the surface of passive investing, a hidden pain of inadequacy can surface. You desire clarity, a way to navigate these emotional currents with unwavering discipline. There's a pervasive myth that passive investing automatically inoculates you against behavioral biases, but this belief often hides the powerful grip of loss aversion and the herding instinct that can seize even the most committed passive investors. During a market crash, the impulse to panic sell can be overwhelming, quietly negating years of diligent, long-term compounding. We're uncovering the hidden truths behind wealth accumulation. This expectation of automatic emotional resilience is shattered by a profound truth. The psychological traps that lead to market underperformance are often amplified, not eliminated, by passive investing. If an investor lacks the deep-seated discipline to stick to their plan, when the market truly tests their resolve, they can mistake volatility for permanent loss. The quiet whisper of fear can turn into a roar, leading to impulsive actions that betray their own long-term goals. Don't just invest, understand the why behind every decision. To cultivate this crucial discipline, consider a mental healing model inspired by Daniel Kahneman's work. Recognize your system 1 impulse is that fast, emotional reaction to market volatility, the sudden tightening in your chest. Then, consciously engage your system 2, your slow, rational mind, to re-evaluate your long-term passive strategy. This means relying on predefined rules for rebalancing and capital allocation, established in moments of calm, not during the storm. Beyond the headlines, what's really driving the market? The rush of dopamine you feel when a complex strategy suddenly clicks. That aha moment, coupled with the intellectual discomfort of cortisol when a long-held financial assumption is challenged, are both critical forces. They drive the engagement needed to forge the emotional discipline required to truly master passive investing through all market cycles, preventing those costly, impulsive errors. Are you ready to face your own behavioral traps? Challenge the consensus. Find your edge. We have journeyed together, peeling back the layers that often obscure the true nature of passive investing. We've seen how the illusion of autopilot still demands an active mind, how costs extend far beyond simple expense ratios, and how market cap weighting can lead to subtle overconcentration. We've acknowledged the unseen hands of active investors that give passive strategies their very foundation, and confronted the behavioral traps that lie in wait during market downturns, ready to test our deepest resolve. This journey from blind acceptance to critical understanding is not about dismantling passive investing. It is about empowering you. It's about transforming a potentially fragile reliance into a robust, strategically informed approach. This deeper insight enables you to optimize your passive path for true, sustainable wealth creation, moving beyond the superficial to the profound. Warren Buffett, with his characteristic clarity, once said, "Risk comes from not knowing what you're doing." This profound wisdom extends its gentle hand even to passive strategies. True mastery comes not from avoiding the market, but from understanding its intricate mechanics, its inherent limitations, and most critically, your own behavioral biases. It is in this knowing that true financial independence is forged. Don't just invest, understand the why behind every decision. Now, take a moment, close your eyes, if only for a breath, and visualize your portfolio not as a static collection of assets, but as a living, breathing ecosystem. What roots run deepest? What currents flow unseen? What hidden truths have you now brought into the light? This is your sacred garden, and you are its mindful steward. Integrate these critical insights. Sculpt a truly resilient and strategically informed passive portfolio, one that moves beyond mere simplification to embrace sustainable financial mastery. As you step forward, what truth will you now actively tend to cultivate a harvest of genuine, sustainable wealth?